Hey there, financial explorers. Thank you for joining us once again on our journey through the intricate landscape of financial instruments. Today, we're delving into the fascinating realm of treasury bills, those ingenious US Treasury securities that have the potential to yield an impressive interest rate of over 5% within a 6-month investment period. Now, these might sound like the typical fare you catch during your morning news segment on business, but hold on to your financial hats because there's a new contender in the arena, the mighty I-bond. Yes, you heard it right. The I-bond, the unsung hero of the investment world, has the potential to secure a whopping interest rate of almost 7%. What sets them apart? These financial powerhouses are designed not only to grow your wealth, but also to shield it from the menacing grasp of the inflation monster that has been wreaking havoc on prices in recent times. In this deep dive, we'll unravel the intricacies of both T-bills and I-bonds, comparing their features, risks, and rewards. By the end of our exploration, you'll be armed with the knowledge to make an informed decision and select the financial sidekick that aligns perfectly with your investment goals. So, buckle up, fellow financial adventurers, as we navigate the twists and turns of the financial landscape and uncover the secrets to maximizing your returns while keeping your hard-earned money safe and sound. Now, when it comes to buying these US government securities, I personally go straight to the source, Treasury Direct. It's like cutting out the middleman and getting your financial goods directly from your local uncle. But hey, you can grab these treasures from other places too, if that's your jam. Alright, let's start with the I-bonds. These bonds are like the superheroes of the savings world, fighting against the evil inflation forces, currently rocking an interest rate of 6.89%, and that's the deal until the end of April. After that, it's a bit like waiting for a sequel. We don't know exactly what's coming, but it's probably going to be lower. The catch with I-bonds is that the interest rate sticks around for 6 months. So if you hop on the train now, you're riding that 6.89% wave for the first half of the year. Not too shabby, right? But hold on to your financial capes, there's a plot twist. These bonds are like the James Bonds of the savings world. They're not exactly shake it, not stirred. You can't bail out until 12 months have passed. And if you try to make an early exit before 5 years, you lose the interest from the last 3 months. So they're kinda like those long-term relationships. Commitment is key. Now, let's talk about taxes. Nobody likes them, but they're part of the deal. With I-bonds, you're paying the piper. I mean, the government, federal income taxes on the interest. But hey, at least state and local taxes aren't joining the party. And here's a cool fact. If you use the money from selling an I-bond for higher education expenses, you might dodge the tax bullet entirely. Just imagine, tax-free savings for college. But there's a limit to the I-bond party. A cap of $10,000 per year per social security number. But don't worry, if you're feeling like a financial superhero and own a company, you can throw in another $10,000 with your EIN. Team up with your spouse, and you've got a shot at $20,000. The more, the merrier. Now, shifting gears to the other player in the savings Avengers, the T-bills. These are like the sprinters of the savings world, offering short-term options ranging from 4 to 52 weeks. The interest rates, well, they're like that roller coaster you can't predict, always changing, especially with recent financial roller coasters in the market. At the time of writing this script, the 4-week T-bill was at 4.7%, the 1-year at 4.8%, and the 6-month, the crown jewel, at a sweet 5.13%. But hey, the financial market is a bit like a soap opera. Things can get dramatic real quick, and these rates might have shifted. Keep your eyes peeled. Now, the cool thing with T-bills is you buy them at a discount. It's like a money coupon. Who doesn't love a good deal? With a 5% interest rate, snag a $100 bill for $97.50, and voila, the $2.50 difference is your profit. T-bills are flexible. No long-term commitment required. Need to bail after 6 months or roll it over for a year? No problem. They're the free spirits of the savings world, and you can keep the sequel coming by rolling over and buying more bills at the next auction. Now, taxes? Can't avoid them. T-bills come with federal income taxes on the profit, but like I-bonds, state and local taxes are sitting this one out. And here's a cool feature. You can sell T-bills before they mature. Just transfer them to a broker and give them the green light to sell. Short and sweet, just like T-bills. But wait, there's more. You can be the high roller in this game. The maximum you can throw down in one go is $10 million, and there's no yearly cap. That's right, if you're swimming in cash, T-bills got you covered. So here's the showdown. I-bonds versus T-bills. Picture this, I-bonds with their 6.89% for the first 6 months, then a potential dip, let's say to 4% for the next 6 months, averaging out to a respectable 5.44% over the year. Not bad, right? But remember, you're in it for the long haul, 12 months minimum. On the other side, T-bills, with their short-term charm, maybe not as high as I-bonds, but hey, the 6-month T-bill is still hanging out close to 5%, and you can bail out after 6 months or roll it over for more. Flexibility at its finest. Now, for the twist in the plot. Recent financial chaos might have caused a bit of turbulence in the T-bill rates. The fear is that the Fed might hit the brakes on interest rate hikes, and that could mean a dip in T-bill rates. But, and it's a big but, if the market doesn't turn into a financial thriller like 2008, T-bill rates could still rise with Fed rate hikes. Fingers crossed. As your friendly internet companion, not a financial guru, but a guide on this expedition, let me share my thoughts. If you're in it for the long haul, safeguarding your savings against inflation, consider I-bonds. With a potential yield of nearly 7%, they could be your financial avengers, protecting against inflation and securing your financial future. Picture yourself in a financial saga with I-bonds as your trusty shield against the inflation monster, embarking on a shorter mission, like saving for a dream home down payment. Meet your trusty sidekick, Treasury bills. With steady returns and short investment periods, T-bills offer a stable platform for financial goals, efficiently accumulating funds without the commitment of long-term investments. As you navigate the financial landscape, remember that the key is finding the right allies for your specific goals. Whether you're embracing the long-term saga with I-bonds or opting for the quick mission with Treasury bills, building a diversified strategy tailored to your needs can be your ultimate superpower in the world of finance. Fellow financial adventurers, we conclude this chapter of our exploration. Fear not, the journey continues. Subscribe for money-savvy content, staying well-equipped for the twists in the vast realm of finance. Until next time, stay financially fabulous, and may your investments be as epic as the tales we weave.